Welcome to this explainer. I am so excited to jump into this with you today because we're looking at something that is literally going to flip how you look at a business's health. It's this fascinating reality that looking merely at the cash paid or received in a business is, well, quite often a total illusion. Today, we're going to tear down that illusion entirely and build up the reality using some truly eye-opening structural tools. Picture this. You decide to pay your rent for the entire next year, today. Cash leaves your bank account immediately, right? So is that a current expense for this year? It's a super simple question, but it totally shatters a very common assumption. Just because cash leaves the bank doesn't automatically mean it's an expense for the current year. If you actually record it that way, you are drastically understating your current profit.
All right, so here is our roadmap for this explainer. To find a business's true profit, we've got to conquer the 4 main quadrants of year-end adjustments, plus a really cool special case. We'll start with our foundational rule, the matching principle. Then, we'll tackle accrued expenses and prepaid expenses, followed by their mirror images, accrued incomes and prepaid incomes. And finally, we'll wrap up with the stationary special case.
Let's kick things off with Section 1, the matching principle. There is a stark contrast between illusion and reality here. What I like to call the cash illusion is what happens if you only record exactly what cash was paid or received during the year. But doing this, it creates a highly distorted view. You might look absolutely broke when you're actually highly profitable. We have to use the matching reality instead. This principle dictates that only expenses and income relating to a specific financial year should be included to arrive at the correct profit or loss. They must match the period in which they were incurred or earned, regardless of what the cash flow looks like.
So how do we bridge that gap between cash and reality? We do it through year-end adjustments. You can basically think of a year-end adjustment as financial time travel. It's a precise tweak made to the financial records to ensure we're showing a true and fair view of the profit or loss for that specific year. We are essentially moving money backward or forward to the correct accounting period.
Moving right along to Section 2, accrued expenses. By definition, an accrued expense is recognized before it's even paid. Because it's a debt the business actually owes for the current year, it's got to be recorded on the statement of financial position as a current liability. Think about it. You use the electricity, you just haven't paid the bill yet, but that expense absolutely still belongs to this year.
This perfectly illustrates the concept in action. Take Abraham's rent account, for example. He contracted to pay his landlord $1,200 a year. But look at the debit side. He only made 4 cash payments of $250, which totals just $1,000. To reflect the matching reality, we have to recognize the $200 he still owes. That $200 balancing figure, the accrual, allows us to transfer the true $1,200 expense straight to the income statement.
The absolutely crucial point here is following these exact steps. First, recognize the accrual. Second, record your cash payments as usual. Third, and this is where the magic happens, adjust at year-end by debiting the expense account with the accrual amount and carrying it down as a credit balance. Remember our spatial rules. Debits increase expense accounts and credits increase liabilities. Finally, you just transfer that perfectly matched total to the income statement.
Flipping the script, here's Section 3, prepaid expenses.
A prepaid expense is paid in advance for the next financial year. Now, this should blow your mind just a little bit. Paying early actually turns your landlord or your supplier into your debtor. For a short period, they literally owe you the value of that service. And that is exactly why a prepaid expense is recorded as a current asset on your balance sheet.
Let's analyze Sheldon's ledger. He paid $600 in cash, but $50 of that was actually meant for next year. By recognizing that $50 prepayment as a balance carried down, we effectively subtract it from the cash paid. The remaining $550 is the true expense that perfectly matches the reality of this current year. And that's the number that goes to the income statement.
Let's look at the other side of the coin in Section 4, accrued incomes.
So, the matching principle applies just as strictly to income as it does to expenses. An accrued income is recognized before receipt. Because a tenant or a customer owes you this money for services you've already provided this year, it represents a current asset that we absolutely must count right now. If we don't, we are artificially understating our profits.
Looking at the rent receivable account here, we see $560 of cash was actually received. But the tenant still owes $70 for this year. We cannot ignore that. By adding the $70 accrual, we reveal the true $630 income for the year. The $70 balance is then carried down as a debit balance, which is a current asset, for the next accounting period.
And rounding out the main quadrants, Section 5, prepaid incomes.
Now, while it feels amazing to get cash early, receiving it before you've actually earned it creates a current liability. Why? Well, because you technically owe that customer a service or product next year. You have a literal debt of service to fulfill.
Let's look at Jaden's timeline to make this concrete. His financial year ends on August 31st, but back on October 1st of the previous year, he paid for 12 full months of rent. That payment covers him all the way to September 30th. This visually demonstrates how that chunk of rent spills right over the August 31st boundary, creating exactly 1 month of prepaid rent, $200, that belongs entirely to the next financial year.
To process prepaid income correctly, like Ali did when he received advance commission in our source text, we just follow these logical steps. We credit the income account when the cash is received. Then, at year-end, we debit that same income account with the prepayment amount to reduce it. Remember, debits decrease income accounts. We then carry that prepayment down as a credit liability balance for the following year.
Which brings us to a fun little outlier. Section 6, the stationary special case.
Okay, here is a truly fascinating accounting plot twist. Stationary is physical inventory, right? But it actually behaves exactly like a prepayment. Take Eureka Motors. They bought $600 of stationery, but at year-end, they had $100 of it just sitting unused in a supply closet. We don't just call the whole $600 an expense. The true expense for the year is only $500. That unused $100 of pens and paper is carried down as a current asset because its benefit is going to be received next year.
If you are ever stuck trying to balance these accounts, this right here is your ultimate cheat sheet. It summarizes exactly where debits and credits live for both opening and closing balances across all 4 of our quadrants. The crucial takeaway is memorizing this matrix. Accrual closing balances for expenses live on the debit side, while prepaid closing balances for expenses live on the credit side. Lock in this mental map, guys. It is absolutely the key to unlocking the matching reality.
Which brings us to our final thought. Look at your own business, or the businesses you're studying right now. Does your cash balance tell the whole truth, or are you operating under the cash illusion? True financial reality is almost never found just sitting in a bank account. It's found in the masterful puzzle solving of year-end adjustments. So the next time you look at a profit or loss statement, I want you to ask yourself what hasn't been paid yet and what was paid too early. Because the answers to those questions might just change everything. Thank you so much for joining me on this explainer.